Now it's time to go deeper on Europe and what's happening within the European Union. Where are some of the drivers and some of the issues that we continue to see? And obviously, lockdowns have been extended. Vaccine rollouts have been sort of delayed. There's some concerns about getting the vaccine, as we showed in the first segment. These are continuing things that will weigh on the underlying, I guess, economic health of Europe in general. So we'll try to find some different data points, and I'll try to pull some more recent ones because obviously the European Union is a big place and there's a lot of data points, so it's hard to put it all into one spot. But before we get into this chart, just want to remind you, please like, share, subscribe. Any comments, recommendations, things that you'd like to see specifically in the European segment that maybe we aren't doing, please let us know. That your feedback is appreciated. So when we look at the general government budget balances, as clearly nobody's saving money. So we have percentages of GDP. Budget balances will remain negative. We'll continue to borrow in order to make themselves whole. The question is going to be how much pain is going to happen. Now, because the Italian issues happened while we were filming, and we're not going to be able to kind of show all this, we'll pick it up next week. But there continues to be a very big issue at the government level in terms of ministers resigning, losing a certain amount of support, which is going to hurt just the general, does this mean the prime minister is there going to be a vote of no confidence? How is that going to shift as Italy continues to borrow more and more? Because if we look, Italy is third to last and if you just look at 2020, they were borrowing 11%. 2021, they're expected to be at about 8%. And then 2022 is supposed to be at, 5%. But government budget balances. And it's just we continue to see these problems where Germany, 2020 and 2021, they're continuing to see some of this pain that is only continuing to roll through. Again, weighing on just general economic activity as they try to spur activity and get things operational. This is going to be a very big problem, especially when we look at France, Italy, Spain, which are kind of rounding out the bottom as they continue to borrow to try to stimulate, which when you have rates at 0 and below, why not? If you're paying me to take your money, then why not? And I think the rate shock is going to happen at some point to try to offset that. But the underlying components remain when we look at, okay, well, what's retail trade volume? And you can see the retail trade volume for the Euro area. The EU is shifting in the wrong direction. Now, when we shift over and I go through some of the numbers here, like Spain, industrial output was down in year over year in Spain was down 2%. Industrial output was down 3.8%. Industrial production month over month was down 0.9% versus being up 2%, up 0.2%. We're seeing this shift, and that's why when we look at not only tourists, but also just general activity is lagging, and we're seeing it in countries that have even loosened up some of their travel restrictions and lockdowns, and this is the kind of closeout of the year, and we're not starting the year any differently with just, France completely whiffed on just the consumer in general, and I say that because France is going to have more problems if the consumer doesn't come back, if things remain problematic, because that means that we're going to have to see more borrowing, with France already being fourth from last for the biggest deficit that's expected as we go through not only just 2020, but also 21 and into 22. Then when we look at job postings, like how is the jobs market doing as we go forward? We talked about it in the U.S. We talk about all the issues in the U.S. Well, is it any different in Europe? And the answer is no. The job market remains under pressure. Spain, UK, France, Germany, everything is below last year. Germany's doing a little bit better, but we're not seeing the snapback higher. We're just plateauing and flatlining at these levels. Obviously, lockdowns don't help, but we haven't seen any marked change, which is going to put additional pressure on the consumer, is going to put additional pressure on just GDP, where with the new issues with the government, the Italian government, growth has been revised lower, going from, the expectation of 3.5% to 0%. These are again, the market is priced perfectly, and any type of hiccup is going or should reverberate through the system and result in lower prices for stocks and other types of risk assets. And this is why we continue to look at some of these indicators that are showing a bigger problem. The Eurozone, the retail sales breakdown, this is what we've been talking about. When we look at the retail sales, we see a big, so Germany was positive, and Germany wasn't enough to offset France, Spain, rest of European zone. This is where Germany has been able to maintain a certain amount of stability throughout all of this, while all of these other countries have seen a really big step down. But think about retail sales. So Germany's VAT tax expired end of year. So were people just buying ahead of that because they knew that there was going to be a snapback and they wanted to fill or meet the needs that they knew that they had ahead of the increase in VAT tax? This drawdown is something that I think is going to continue through not just December, but into January, February, as the retail sales fall, because you have less tourists, you have people just doing less in general, not only internationally, but locally, which will weigh on just general activity. And that's where we continue to look at, CPI. That obviously it remains negative, but it's negative in a different way, as we talked about last week. I mean, yes, energy is down 8%, but who is seeing that benefit? And food costs are up 5%. So you're telling me that energy prices are down 8%, but I'm not experiencing it, and when my food price, which you're quick to push through, is up 5%. That's not good for me in general, because you're not seeing those savings across, move to the person's wallet. And this is looking at Italy in general. So retail sales were down 6.9% month over month, year over year, down 8.1%. Industrial production, big miss. Month over month was supposed to be down 0.4%, was down 1.4%. Industrial production year over year was supposed to be down 2.6%. It was down 4.2%. This again, I can't stress enough how I expect to see big numbers continuing to disappoint to the downside, and you see GDP continue to be revised down. As we've been saying, we thought GDP expectations were already too elevated. And this is what we were seeing. These are the types of indicators that we've been talking about, because this is obviously in November. We're in January. This is a lagging indicator. This stuff already happened. So we use leading indicators and present time indicators to say, okay, well, where should this shake out? And that's where we had this confidence that expectations were already too high, and you're going to continue to see this brought lower. Now going into some of the other data points. So Eurostat retail sales, as we talked about earlier, estimate was to be a growth of 0.9%, and it came in at negative 2.9%. Now we talked about who drove that decline. It was France. It was Spain. It was the rest of the European zone. So that's why Germany was the slight offset. So without Germany, this would have been way worse, and that's why the estimate should have already factored in the VAT tax change in Germany. Maybe it didn't, and there was, or maybe it expected it too much and France offset it. But this is again talking to the health of the consumer. And when we look at German manufacturing, now Germany remains the bright spot. So the estimate for German manufacturing was supposed to be negative 2.1%. They crushed it with an actual 6.3%. This is a net positive. And if we look at toll roads, and we are trucking toll miles, and they continue to be up. In the U.S., they're up about 10 to 12%. In Germany, they remain, anywhere from 8 to 10%. This is obviously good for diesel demand, but also showing that there is activity that's remaining in Germany. And as we talked about last week, a lot of it is going to China. And that question is going to be, how does that relationship work as we start to see a ratchet up of pressure on human rights violations. And as you know, this past weekend, we had a huge sweeping issue in Hong Kong where China arrested several key members of the protest and a U.S. citizen that was a human rights lawyer. So again, these are things that are going to have to be weighed. But right now, China remains a bright spot for Germany. Now, German industrial production year over year, the estimate was supposed to be down 2.3%. Actual was down 2.6%. So, there is some wavering in terms of, okay, well, what are manufacturing orders? So orders were up, but we had production flat. And so that, again, we're doing, the orders are showing something better, and we should start to see some of the industrial production come up and meet it, which is why the German jobs market has been better than some of the others, because they have this industrial component that a lot of these other countries don't have to the same regard. And then when we look at this a bit differently and a bit broader, we can take this and say, okay, well, let's look at the European Commission Consumer Confidence Indicator. So let's look at the Eurozone in general. So when we look at the Eurozone in general, you can see that on a consumer confidence level, it was down 13.9%. Economic confidence, it was expected to be 89.8, came in at 90.4, slightly better. That is a positive overall, again, more driven by Germany. Industrial confidence was supposed to be down 8.6. It came in at down 7.2. Services confidence came in at was expected to be down 15, came in at down 17.4. This is the bifurcation that we keep talking about. Industrial remains stronger than services, where services continue to weaken. We continue to see problems overall in terms of just what is the activity on the service side, while the industrial continues to, it's still down, it's still negative, but it's not as negative as expected. So when we look at retail sales and we start to factor in and put together GDP, now that we have a ratchet up of political uncertainty with Merkel, who's going to replace Merkel? What person is Germany going to go in a different direction? There is going to be some shifts as to, on a political side, Italy and Germany will be the ones to watch as we go through 2021. And will we get a pivot with the way European economics go, the way they interact with China, the way they interact with the U.S., with a Biden administration? There's a lot of unknowns, and there's a certain amount of knowns, given that we still remain the main part of NATO. We're still Germany's military. So there's only so much of a pivot. But again, things to watch, things to consider as data continues to soften when we look at GDP, when we look at retail sales, as we highlighted, as we look at industrial production, as we look at wholesale prices. Like when we look at Germany in general, wholesale price index year over year was down 1.2%. That industrial output in different areas is flat to down. The industrial production, as we talked about, continues to be where do we go from here? And I think that remains the underlying question of, there's a lot of unknowns, but yet in Europe, things continue to price like everything is going to be fine. The euro, it's down today because the dollar has strengthened a bit, but the euro remains fairly well bid. It's still at $1.21.5. It probably shouldn't be there, but how do you knock it down? Because people, and by people, emerging markets, are issuing debt in euro denomination. Why? Because it makes sense given the fact that the European investor is looking for yield, and they're going to get it from emerging markets, and that's a natural buyer of euro. These are the things that are going to weigh on how does Lagarde try to weaken the euro to help protect some of the exports, to help keep industrial movement going, and try to increase services as you try to normalize and strengthen or weaken the currency to make it more appealing in the international markets. And these are some of the unknowns, because Europe is a very interesting beast at this point, given some of the mixtures and differences and the extensive, let's just call it the extensive, easing and support that these economies are getting. But that's Europe in a nutshell. And now we're going to turn to Asia and really kick off with some of the underlying geopolitical issues that we're watching as we get ready and see how things are adjusting into a potential spring thaw that could see an increase in conflict between both India and China.